Today, we are going to tear down the most sacred cow in personal finance, the concept of saving for retirement. If you are currently dumping money into a 401k or a standard savings account with the goal of hitting a magic number, say $1 million or $2 million, so you can finally quit your job at 65 and live off the interest, I have a terrifying 2026 reality check for you. That math is dead. The traditional retirement playbook was built in the 1990s. It was designed for a world with 2% inflation, predictable healthcare costs, and a bond market that offered risk-free yields. We do not live in that world anymore. In 2026, we are living in an era of sticky inflation, hovering around 3.5% to 6.5%, a rapidly depreciating dollar, and the fallout of the One Big Beautiful Bill Act. If you try to save your way to retirement today, you are playing a game of financial musical chairs, and the music is about to stop. Today, we aren't just going to look at why your nest egg is melting. We are going to completely rewire your financial brain. We are transitioning from target accumulation to cash flow engineering. Welcome to Principle and Profit, where we help individuals understand how to build wealth through value investment principles that secure a future where financial stress is nothing but a theory. Let's look at the data. For 30 years, the financial industry worshipped the 4% rule. The idea was simple: build a massive pile of money, invest it in a 60-40 portfolio, split between stocks and bonds, and withdraw 4% of it every year, adjusted for inflation. Historically, this meant your money would last 30 years. But the 4% rule has a fatal flaw in the 2026 economy, which is a sequence of returns risk combined with structural inflation. Let's look at the mathematical reality of purchasing power erosion. If you hit your magic number of $1 million today, but real-world inflation, housing, healthcare, energy runs at 6% annually, we can calculate the true future value of that capital using the purchasing power erosion formula, and the formula shows that in just 12 years, the purchasing power of your $1 million nest egg drops to roughly $480,000. You have lost over half your wealth without spending a single dime of the principal. If you retire into a bear market, which is highly probable given the current 50-year high in market concentration, and you are forced to sell off stocks while they are down 20% just to buy groceries, your portfolio enters a death spiral. You are liquidating assets at a discount to pay for basic survival in an inflated economy. Saving a lump sum and hoping you die before it runs out is not a financial plan. It is financial anxiety. So, what do we do instead? We build the Perpetual income engine. The wealthy do not save for retirement. They acquire assets that generate cash flow. They don't care what the magic number of the asset is. They care about the yield. Your goal isn't to accumulate $2 million. Your goal is to engineer $6,000 a month in passive, inflation-adjusted cash flow. How do we do this? By transitioning from a drawdown portfolio to a yield portfolio. A. The dividend aristocrats and kings. Instead of broad, market cap-weighted index funds that rely on capital appreciation, hoping the stock goes up so you can sell it, we pivot a portion of our fortress portfolio to quality dividend growth. We look for companies that have increased their cash payouts to shareholders every single year for 50 years. When inflation hits, these companies, which usually produce consumer staples, energy, and healthcare, raise their prices. When they raise their prices, their revenue goes up, and they pass that inflation directly to you in the form of higher dividends. Your income rises with inflation. B. Hard asset yields, REITs. We discussed this in our Fortress Portfolio video, link in the description. You don't need to be a landlord dealing with broken toilets to own real estate. By allocating capital to high-quality real estate investment trusts, REITs, specifically in logistics, data centers, and emerging markets, you are securing a 5% to 8% yield backed by physical infrastructure. C. The yield math. If you build a portfolio with a blended yield of 5.5%, you never have to sell your principal. If you need $60,000 a year to live, you need a perpetual income engine of $1.1 million. Wait, didn't I just give you a magic number? No, because the $1.1 million isn't meant to be spent. It is the factory that produces your salary. Even if the market crashes and the value of your factory drops to $800,000, as long as the dividends and rents are still being paid, your $60,000 salary remains intact. You have decoupled your survival from the stock market's mood swings. Now, we have to address the elephant in the 2026 room. The number one cause of bankruptcy for retirees isn't a stock market crash, it is medical expenses. Medical inflation outpaces standard CPI by nearly double. If you are just saving cash, a single chronic illness will wipe out a decade of frugality. We must build a healthcare moat. The HSA Super Account Optimization. If you are using your health savings account, HSA, to pay for today's copays, you are doing it wrong. In 2026, the HSA is the ultimate stealth wealth vehicle. It is the only account in the U.S. tax code that is triple tax advantaged. 1. It goes in tax-free. 2. It grows tax-free. 3. It comes out tax-free for qualified medical expenses. The strategy? Pay for your current medical expenses out of pocket using your Tier 1 instant buffer. Invest 100% of your HSA funds into low-cost, high-quality ETFs and leave it there. Let it compound for 20 years. Save your receipts digitally. Because there is no time limit on reimbursing yourself, at age 60, you can withdraw decades worth of medical expenses completely tax-free. This creates an impenetrable moat around your perpetual income engine, ensuring your dividends go toward your lifestyle, not your prescriptions. The One Big Beautiful Bill Act's reality check. As we covered before, the One Big Beautiful Bill Act slashed traditional subsidies, but it expanded employer-funded HRAs. If you aren't negotiating a HRA contribution into your current salary package, you are leaving an inflation-adjusted health buffer on the table. Finally, we need to redefine the word retirement. The idea of going from working 60 hours a week to doing absolutely nothing at age 65 is biologically and financially toxic. In 2026, we practice capital-efficient unretirement. Instead of stopping work entirely, you transition to high-leverage, low-stress, anti-fragile work. Because AI has displaced repetitive tasks, the premium in 2026 is on human advisory, consulting, and localized physical skills. If your perpetual income engine generates $4,000 a month and your survival burn rate is $5,000, you don't need another $200,000 in the bank. You just need a part-time, low-stress skill that generates $1,000 a month. This covers the gap. Crushing the survival burn rate simultaneously, you must relentlessly drive down your structural overhead. Geographic arbitrage. We talked about the 45-minute raise. In retirement, this becomes the global raise. Moving your capital from a high cost of living state to a zero income tax state, or an emerging market, effectively doubles your perpetual income engine without you saving another dollar. Owning your infrastructure. Stop renting your life. In the decade before you step back from full-time work, your goal is to eliminate monthly liabilities. A paid-off home, a paid-off reliable vehicle, the 200K mile flex, and a residential solar array. If you remove your mortgage and your power bill, your required yield drops drastically. You don't need $2 million to retire if your life only costs $3,000 a month to live like a king. Let's summarize the principal and profit alternative to saving for retirement. Stop worshiping the lump sum. $2 million in cash is a melting ice cube. 2. Build the perpetual income engine. Focus on acquiring assets that pay you a reliable, inflation-adjusted yield, quality dividends, and REITs. 3. Build the healthcare moat. Weaponize your HSA as an investment vehicle, not a checking account. 4. Lower the ceiling. Drive down your structural overhead so your required yield is easily attainable. 5. Embrace unretirement. Use your human capital to bridge the gap doing work you actually enjoy. You are not a victim of the 2026 economy. You are the engineer of your own financial fortress. When you stop obsessing over a magic number and start focusing on cash flow and infrastructure, financial stress transitions from a daily panic into a mathematical theory. If this video fundamentally changed how you look at your future, we need you to hit that like button. It tells the algorithm to push this data to other people who are panicking about their 401k. Subscribe to the channel to join our community of fortress builders. Now, we want to hear from you in the comments. What is your target monthly cash flow number? Not your lump sum, but the monthly yield you need to cover your base lifestyle? Put it in the comments below, and let's start reverse engineering it together. I'll see you in the next one.